retirement thing is so overrated. And, retirement means different things to different people. And I still wanted to participate in life. I still wanted to, create impact. And for me, I said, Jake, the only way I can do that from being so far away is let's start Jake and Gino. Let's start the education. Let's start writing the book. We wrote Wheel of Our Profits. We started the podcast. And a couple of years later, we started the education company. And from there, our students to date have closed over 53,000 units. They've closed over $4 billion in assets in the last 5 years. And to me, that's been the part of my life where I've had the most impact. And I know one of the things that you probably want to talk about is what drives me today. And that's really what drives me today is just creating that impact for the students.
That was Gino Barbaro. Stay tuned for a high energy discussion. The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing their real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast. All right, welcome partners. Again, this is your host, Jake Wiley. This week, I'm joined by Gino Barbaro. So he's a founder at Jake and Gino. So I know they've got education, but they're also owners of over 1,800 multifamily units. Gino, welcome to the show.
Jake, I love that name because my partner, Jake Stanziano, changed my life, and we're going to have a really nice conversation today. How you doing?
I'm doing good. I can't wait to get into it. But I guess let's actually get into your background. Let's hear some of this background story about, you, Jake and Gino, maybe the partnership and how you guys got into multifamily.
I got out of college a long time ago, back in 1992. I worked for AIG Insurance, and did I like it? Not really. It was reinsurance accounting. I worked there for a year, and then I decided after that, what am I going to do? My father had a restaurant, so I decided in 1994 to open a restaurant, family restaurant, and I owned that until 2016 when I left. But the first 15 years of that were great. I loved the restaurant. In 2008, the Great Recession hits, and I say to myself, I need to do something different. I need to figure out, I've got 6 kids, and I'm working harder, making less money. And I met Jake in 2009. He was a pharmaceutical rep, so we're affectionately known as the pizza guy and the drug rep. In 2011, thankfully, he moves down to Knoxville, Tennessee, and we start looking at assets down there. It takes us 18 months to find our very first deal. And I knew multifamily was the right vehicle for me because I already had a full-time job. I was working in the restaurant. I didn't want to fix and flip. I didn't want to get in the single-family home. I already owned a fourplex, and I had already made a bunch of mistakes buying other assets. I'd bought a mobile home park. I had bought a strip center up in New York. They didn't work out for me. So I went in all in on multifamily. And in 2013, Jake and I, after 18 months, we found our first deal. 3 months after that, we found our second deal. And within 12 months, we owned over 200 units. And the cool thing about it was Jake left his job about a year and a half after we started buying deals. Like I said, I left in March of 2016. And since then, we've been able to, do over 1,900 units. And the great thing about us is we only syndicated 3 deals. We've gone full cycle on 2 deals. And the remainder of the units, the majority of them are owned by me, Jake, and a partner, Mike. And for the last 2 years, we've been allowing our employees to invest in our deals, which has been phenomenal to see our property managers, our maintenance techs, and the people at Jake and Gino investing in our deals.
Well, I always love kind of the origin story. And I know that in addition to the investments you guys have, you're also in education. Let's talk a little bit about that. What's the Jake and Gino show?
So what happened, Jake, in 2016, I left the restaurant business and I'm like, okay, I'm up in New York. Jake's in Knoxville. He's running the deals day to day. I remember never forget this, June 23rd, 2017, I decide we finally leave New York. I moved down to Florida. So I've been here in Florida for the last 5 years and I was going to start buying assets in Jacksonville. But you listen to the locals and everyone's saying cap rates are compressed in 2017. There's no deals, blah, blah, blah. They've been saying that for the last 5 years. I don't buy any deals down here. So I say, Jake, I need to do something. I can't sit around doing nothing. This retirement thing is so overrated. And, retirement means different things to different people. And I still wanted to participate in life. I still wanted to, create impact. And for me, I said, Jake, the only way I can do that from being so far away is let's start Jake and Gino. Let's start the education. Let's start writing the book. We wrote Wheel of Our Profits. We started the podcast. And couple of years later, we started the education company. And from there, our students to date have closed over 53,000 units. They've closed over $4 billion in assets in the last 5 years. And to me, that's been the part of my life where I've had the most impact. And I know one of the things that you probably want to talk about is what drives me today. And that's really what drives me today, is just creating that impact for the students. But selfishly enough, the education has really taught me so many things about becoming an investor. I've learned about the 3 pillars of real estate. We've created this framework to teach others to invest, but I've also become a much better investor. I've been on podcasts with Robert Kiyosaki, with T. Harv Eker, a couple of my mentors that I actually remember growing up reading and listening to, Zig Ziglar's son, Tom Ziglar, and the list goes on and on. So the education, you want to say it's a way to monetize and create an additional stream? Yeah. But the benefits other than monetizing have been astounding to me and really have led to my growth as an investor and also as a person. Now I'm actually doing a podcast with my wife weekly, which is fun. We call it the Julie and Gino Show. So the education started off as this thing to monetize and create the stream of revenue. But to me, it's grown into something vastly more important in my life.
I love that. Now, I'm just curious, was it Rich Dad Poor Dad that kind of kicked it off, or?
Everyone calls it the Purple Bible, and I would probably say it was. But for me, I think also Napoleon Hill, that Think and Grow Rich, really sparked my interest. And as he was out there writing about all these famous people, whether it was Edison or Schwab or Carnegie, and that just sparked my interest about creating wealth and about a vehicle. And I knew real estate was great because my parents, we own the restaurant, they own the building. So I already knew the real estate was the vehicle. And I was always a great saver, so I could always save money. And another book, The Richest Man in Babylon, it's not that hard. You start reading these books, you start implementing some of these simple techniques like save 10%, secure retirement for yourself, reinvest in yourself, buy assets. I think the Purple Bible really helped me out, but there were so many others along the way that helped me out. I think one of the most important ones, I think to me, mindset-wise, was Secrets of the Millionaire Mind by T. Harv Eker. I read that book back in 2008, and I said to myself, this T. Harv Eker is really a jerk. But then I pulled back. I said, hold on a second. He's not really a jerk. He's just speaking truth. And I don't like the answers to the questions that he's asking. And what he's basically saying is your fruits are in your roots. It's your responsibility. Gino, stop blaming everybody else. Stop blaming the economy. Stop blaming the president. Stop blaming your current situation. And at that point in 2008, once I decided to take responsibility, you see the dominoes in my life start falling. A year later, I fortuitously meet Jake. 2 years later, he moves to Knoxville and we continue to invest and we continue to look for deals. But I had started my education in 2008 after reading that book, and I said to myself, I need to take responsibility. And ever since then, I've been a responsibility junkie. I try not to blame the situation that's going on, whether it's the pandemic back in 2020 or it's the current market cycle or whatever it is. I think that book really helped me out and really made me become that 100% responsibility junkie.
Well, I love that. The Purple Bible, Rich Dad Poor Dad, I hear about more than any other book on the show. What I love about it is that there's something in it that attracts people and gets them to take action, right? Which is the really big piece. Because there's so many books written about real estate and you read them, they go back on the shelf and you do nothing. But that was the one that tips a lot of people. So I always love hearing people's Rich Dad, Poor Dad, Purple Bible stories.
And Jake, let me ask you though, the reality with that book, he simplifies it. I think he's an amazing teacher. An asset puts money in your pocket. A liability takes money out of your pocket. Very simple. He draws the balance sheet, an income statement. He's showing where people's flow of money comes from. Now, if you don't like any of those concepts, that's great. That's on you. But he's showing you how wealthy people and their mindset versus the middle class's mindset versus the poor person's mindset. And it really is mindset. It's not about money, because I know many people who are making 6 and 7-figure incomes that are living paycheck to paycheck. They're not investing in their future. So I think Kiyosaki really is a great teacher when it comes to that. Pick up the book if you haven't read it. I'm sure if you're listening to this show, you have. But if you haven't, pick it up and learn the basic financial education. You need to be able to speak the financial terms if you're going to get into real estate or you're going to start investing. You go to school, there's a report card, as Kiyosaki says. When you come out of school and you start investing, the banker wants to know what your financial report card is. And if you don't know how to speak that language, guess what? You're not going to succeed at the game of money and the game of investing.
Yeah, that's a great way to sum it up. And for me, I think what is an asset, right? An asset is something that puts money in your pocket. A liability is something that takes it out. And your point is spot on. It's so simple, right? And I think if you can always remember that when you're looking at where you're putting your money, it's like, is this an asset or not? Because if it's not, it's a liability and it's taking money out of your pocket. And you're right. It just makes it so simple.
And Jake, let me piggyback with that also. When I tried to explain to my wife all about multifamily, I mean, she's amazing, homeschool, 6 kids. She is a rock star, but she doesn't like real estate. I told her about refi and roll. I tell her about cap rates. She could care less, which is okay. But when I told her, hun, buying an asset, what I used to do is I used to save for an event. I would save for retirement. I would save for a kid's college. The wealthy, what they do is they save to buy an asset, and that asset ends up paying for the event. We bought our first deal back in 2013. I still own that deal. I've got a daughter who graduated college last year. She's a missionary up in Tiger, Georgia right now. Guess what? I paid that college with that first property back in 2013. My son is going to be a junior this year. He's getting his college paid from that asset back in 2013. And the other 4 kids, if and when they decide to go, that asset is going to pay. And guess what? When they are done with college, I still own the asset. But if I had saved for their college, my savings would have been gone. So that is, I think, the crux of the middle class versus the wealthy. The middle class save for the event. The wealthy save to buy an asset that will pay for the event. And I think Kiyosaki explains that really well in the book. But to explain it to my wife that way, she says, Gino, why don't you tell me that from the beginning? I said, I don't know. It took me a while to figure that out myself.
Yeah, if we're on this topic, let's dig in a little bit. I'd love for you to kind of explain the concept of leverage and how that really helps here.
Think about it with multifamily. We bought that property, that very first property back in 2013. We financed 10% of the down payment. So it was a $600,000 asset. We needed 80% bank financing. We needed 10% for the down payment, which was cash from us, and 10% the seller held as a seller finance note. So we needed $60,000 because it was a $600,000 purchase price. And with the closing costs and all, we needed $83,000 for that entire purchase. Now, if you think about it, how many assets can you buy that are worth $600,000, but you only need $83,000 to get the total benefit of that $600,000 purchase price? Very few assets where you can leverage. And there's very few institutions that will lend on that asset at that purchase price. So if you think about it, that asset has appreciated tremendously. It's worth over $2 million today. Reason why that's happened, rents when we bought that property were at $350 for 1 bedroom. They're at $995 plus rubs. So you can see the exponential growth of rents. So with long-termism, we've had that rent appreciation and that rent growth, which has allowed the asset to appreciate in value. We're paying down the principal on that. So the debt on that property is probably $450,000. Most individuals would have sold the property, repurposed it into another asset. What we did is we refinanced it. So let's talk about refinancing the asset. We pulled out $165,000 in 2015 on a refinance. A refinance is basically a loan on the property. You don't pay any income taxes when you refinance a property day one. So for you to pull out $165,000 tax-free, for Gino, the pizza guy, I've got to make thousands and thousands of pizzas to be able to earn $165,000 tax-free. That's on one little property. We've been able to do that in our portfolio. We've been able to refinance over $25 million in refinances on that property and putting them into other assets to continue to grow, to scale. Because people say, well, what happens when you run out of money? Well, when we ran out of money 3 or 4 years ago, we started syndicating and using other people's money. So syndication is just another form of leverage, using other people's money on these deals. And you're on the topic of leverage. Why do I love multifamily more than any other asset? Simply, I'm also leveraging other people's time. When you're buying multifamily and you're scaling up and you have hundreds of units, you can go out and you can hire professional property management. For us, we're vertically integrated, so we manage our own assets. So we're leveraging other people's time as far as property managers, maintenance techs, and you combine that with the leverage of the properties itself. I mean, that's why people are so successful in multifamily. And on top of the tax benefits with cost segregation, you're able to, frontline a lot of that depreciation day one to be able to take against any income that you have. I mean, the trifecta is there. It's amazing all the benefits that multifamily provides for investors.
Well, that was a great explanation, because when you get that leverage, your initial $83,000, several years later, you refinanced it for $165,000, effectively 2 times. Like if you were just saving money and putting it away, maybe you're getting 10% return, right?
Yep. Yes, exactly.
Well, let's change gears a little bit, because obviously you are passionate about multifamily. We got into a little bit, but what about like self-storage, some of the other asset classes that we see are really popular right now? Why are you more passionate about multifamily, even in this like compressing cap rate, where it's been compressing and now we're expecting it to decompress a little bit?
I always come to the idea that I want to be an expert in anything that I do, and I just focus totally on multifamily. Now, for us, like I said, we're vertically integrated, so we manage our own properties. We were thinking about going out and buying some RVs for the last couple of years, the RV space. Now, I want to see how that fares in the next couple of years with gas prices and with what's going on with the economy. But we never veered off of our expertise, because we wanted to become the Chick-fil-A of apartments. We wanted to have the superior customer service. So if we decided to go into self-storage, or in this case, RV parks, it's a different style of management. So we're like, you know what, time out. Let's not chase that shiny object. And for us, I don't want to chase these shiny objects, because I want to become an expert at what I do. And, if you think about it, cap rates have been compressing for the last 2 or 3 years. It hasn't been for the last 20 or 30 years. There is a market cycle. They are going to come back. We have bought about 5 or 6 deals in the last year. Pricing has come down on a lot of these assets. Mom and pops are still out there, so we're still buying, though the asset classes are really good. I like self-storage. I just think apartments, it's a basic human need. It's food, clothing, and apartments. We're always going to need a place to live. And if you look at it from a demographics perspective, where we're investing in the Southeast with the population growth, with the job growth, with the rent growth, with the ability of people now, if we're going to be going into a recession, there was no housing supply to begin with. Now that rates are 6 and 7%, guess what? They're not going to be buying homes. They're going to be out and going renting. And when there's more renters out there, what happens to rents? Rents go up. The demand goes up for the rentals. The supply goes down and you get increased rent growth. And I think personally in the future going forward, you're seeing millennials starting families later. Families are smaller and you're seeing the demographics of the older population selling their homes and they're getting into rentals as well. So there's a bigger demand for rentals going forward. And I think the American dream of renting, of buying a home it's not what it was 10 or 15 years ago. And now as you're seeing with these interest rates going up, it's going to be only even that tougher to go out and buy a home. So I'm really bullish on multifamily going long term. There's not enough affordable housing units out there. So if you own assets right now, hold on to them. My only thing to you is, as you're listening to this, think about buying multifamily or any asset in decades. Make sure you position yourself in a market that you like, where there is population growth, where people are going to live, where it's really, landlord friendly. I'm not investing in New York or California. I like investing in Tennessee. I like parts of Texas. We like parts of Kentucky. We're also like parts of Florida. So keep that in your business plan if that's what we're looking for. So so many ideas, so many reasons why we're bullish on multifamily. The other one is the tax benefits, the ability to take those benefits. And once again, it is a basic human need. As my partner Jake likes to say, you can't buy it on the internet right now. You look at office space, people are working from home. Mobile home parks, that asset class is shrinking because there's less parks or ripping them apart. Those cap rates have compressed tremendously right now. And, a lot of those can be a little bit tougher to manage. You're going into a lower type of resident base. So for us, we started with multifamily. We want to become experts in multifamily, and we just want to continue the journey on multifamily. Does that make sense?
It does. It does. And I think you started to flirt with my next question, which is mistakes, right? What are the mistakes that you've seen people make? What mistakes have you made that you could help avoid some landmines along the way?
Jake, we've only got a few more minutes on the show. I could take hours on the show. A smart person learns from their mistakes. A wise person learns from others' mistakes. That's the reality. I'm still a smart person because I still make tons of mistakes. That's why I created the Jake and Gino community. For me, a couple of the biggest mistakes early on is not doing due diligence. On that first mobile home park, I had a terrible partner, didn't do due diligence. I handed him over the money, didn't know what a syndication was, not educated. I just had extra money. And that was a huge mistake. I should have gotten on a plane and taken a look at those mobile home parks. I should have done some digging on the partnership. Now, pre-2008, it was all his fault. I was the victim. As soon as 2008 came and I read that book, guess what? It's on me. Why didn't I figure out the partnership wasn't good from the beginning? Why did I figure out this asset wasn't the right asset to invest in? Because I didn't take responsibility. I didn't take ownership. In 2007, 2 years after that one, I bought a strip mall. Now, this is a tough one because I didn't know what the 3 pillars of real estate were. We've created this saying in Jake and Gino. And what it is, it's all out there. This 3 pillars. We've just combined them together. And it's market cycle is the first pillar. Debt is the second pillar. And exit strategy is the third pillar. On that second deal, I didn't buy in the right part of the market cycle, or even better, I overpaid and I bought the wrong asset in that market cycle. In 2007, we're at hyper supply. We're at the peak of the market. I go buy an asset that is tremendously distressed. I overpay for that asset on top of it. I buy it in the wrong part of the market. It's up in upstate New York, about an hour north of the city. There's very little demand there, very little job growth, very little population growth. And moreover, I don't have an exit strategy. When you're underwriting a deal or you're looking at an investment, always think about what your exit strategy is with the deal. I said, hey, I'm going to buy and hold it forever. Was that a viable strategy for that property? Absolutely not. I should have thought a lot more lucidly and a lot clearer. Now, if I had paid a lot less, the deal might have made a little more sense. I just overpaid. I overfixed. And I did not know how to manage an asset with commercial leases. That's the reality. I didn't have my education. So as you can see, the lack of education was not there. I took massive action. So when you couple education, you put it together with action, you will get results. And that's why I said in 2008, I need to find out what this multifamily is all about and how to learn and how to underwrite a deal and how to figure out all of these different strategies, whether it's buying it right, managing it, and financing it. So in a nutshell, that was pretty quick because I've made tons of other mistakes, but those are really the high level mistakes that I saw myself making on those first couple of deals.
Well, so for me and my listeners, right, we're limited partners. So we're going to come invest alongside you. And I think what we talk about a lot on this show is you've got to do some work on the front end.
Yes.
And as a limited partner, like you don't have to be able to diligence every piece of the deal, but you do have to diligence the partner that you're working with. I guess what would be your advice for me and my audience here so that we don't learn the mistakes alongside somebody?
That's a great question. What I would say is try to find somebody with a track record. You don't have to go with the first time syndicator. Try to see if they've got some deals that went full cycle. And if they don't have those deals, that may not be the right syndicator that you're going with. There's so many things that you as the investor needs to take into consideration. If you're a limited partner, what are your goals? Some syndicators may want to buy a deal. They may want to flip it out in 2 or 3 years and give you your capital back. What are your goals? Are your goals to hold this deal long term and to say, I want to place this money and hold it for the next 10 years and I'd love to grow this asset? That's the first thing I think you really need to think of yourself. I think the next thing that you really need to think of is, are they in the right markets that you want to be in? You as a limited partner, you have a great advantage. You can have something that what we call diversification. You can diversify yourself into different assets, different syndicators, and also different markets. You can buy a strip mall, you can buy a mobile home park, you can buy in Alabama, you can buy in Tennessee, wherever. So I think look at the market and see if you really like the market. That's really important of where they're investing. Is there job growth? Is there population growth? Is there stability? Other thing I'd like to look at when I'm looking at these assets, even as a limited partner, you should really create something that we call a buyer criteria. In this part of the market cycle that we're buying our assets, we're buying assets that are a little bit newer. We get really granular on this. We are buying assets that have median incomes of at least $50,000 because we want to deal with residents that have a little bit higher resident base. We're buying assets. We love townhomes, brick townhomes, 2-bedroom, 1.5 bath. That's the unit mix that we like. We're also looking for assets, like we said in the 80s. We like assets that have amenities such as washer and dryers. And we love assets in certain parts of certain markets. So become crystal clear as a limited partner where you want to own these assets. Because once you buy that asset, you may have to hold it for the next 5, 6, 7, 10 years. The other thing I'd like to also discuss is as a syndicator, find out who are his or her team members are. Who is their attorney? Who is their property management company, which is really important. And if you find a syndicator that's vertically integrated like us, even better. They're managing their own properties. But you want to know who all of their team members are so you can get an idea of how this asset's being run. And then, hey, go on their portal, see what deals they've done. If they're currently doing deals, check on their deals. And better yet, if they own a few assets, why don't you get in the car or get in a plane and fly out to one of their assets and do a walk around and see how that asset is being run? Because if you're going to put $50,000 or $100,000 or $200,000 into an asset, isn't it worth spending a couple grand on a plane ride to go out and see what that asset's really doing? And then ultimately, I think as a limited partner, you need to get out to events. You need to go to live events. You need to find out who else is syndicating deals. You need to find out, what in the general market is going on as far as what are preferred rates of return, what are co-promotes going on, what are other syndicators out there doing? Because there's a ton of them out there. You want to see what's going on in the market itself. Again, those are just some of the tips as a limited partner. But once again, you heard that word responsibility. You're giving your money to somebody else with the expectation of them to give you a rate of return. It's incumbent upon you to go out there and to make sure that they have executed or they're going to execute their business plan. Read their business plan. Is their business plan in alignment with what you're trying to accomplish? That's one of the most important aspects that you need to look at.
And you brought up something there that I want to draw out a little bit more because I thought it was really important, is that you may say, I'm a syndicator, right? I'm a syndicator and I like the Dallas-Fort Worth area and I'm looking for multifamily there. When I just heard you tell your story about what you're looking for, like you have an area, then you have a property, then you have a property type, townhomes, you like them to be brick, you like them to be 2-bed. Like there's a level of specificity there that's really important, that it really kind of brings out your plan for your business. And I think that's not to be missed, is that when you start talking to people, they may tell you, yes, Dallas-Fort Worth is one of the hottest markets and multifamily is going through the roof. Generally speaking, that may be true. But as we are in a transitory part of the market cycle, and I'd love to get your thoughts on the market cycle, you really got to be specific and you got to have a really good plan of what you like and what's going to perform.
We were just at MFIN Con Big shout out to Dan Hanford, put out a great event. And Jake and I are on stage and we asked them, the audience members, does anyone have a buy right criteria? And these are super high level investors. Not one person raised our hand if they had a buy right criteria. And for us, when we first started, we didn't either. But that's the difference between students who are in the Jake and Gino community and ones that aren't. The buy right criteria allows you to focus. When you have clarity, you can really strike quickly, especially that's what you need in this part of the cycle, right? You need to work quick. We don't lack motivation. We lack clarity. And once you have clarity from this buy right criteria, it's really important. And what we're talking about with the market cycle, the reason why it's important to have this buy right criteria, it's going to change because back in 2013, we weren't buying newer assets. We were buying anything we could get our hands on. Older assets because of the price point where the C properties were as opposed to the B properties. We could pay a certain price. We had a lot of cap expenditures. We could add on that. And there was still a lot of runway. Those assets were priced really small. Now, what's going on in this part of the cycle, the last couple of years, C pricing has compressed to where it's almost close to the B pricing. So why would I pay almost as much for a C as I am for a B when that C is a lot older because I'm looking to hold for a long time unless I'm buying it for a really good price. I'm able to put all that CapEx, all the budget, do all the plumbing, do all the roofs, do all the driveways. I'm able to do that. That's why it's important that you're looking at your buy right criteria and you're evaluating every 6 months. Now, it's not steadfast that we're going to buy just those types of assets because in December, we bought a 1973 asset with a 25 unit. We only paid $65,000 a unit for it. That's why we bought it. We had the CapEx. We're able to raise rents from $600 to $1,300. So that asset is well worth over $100,000 a unit. So we had plenty of runway. That's why we bought it. Now, if that asset was priced at $100,000 a door and we had bought it, we would not have bought that. So it's just a guideline. We call them really, if you're going bowling and you have those bumpers, we want to stay within those bumpers. Our most recent deal, we bought a 2000 build. Townhomes, 1,500 square feet. These were 3 bedrooms. We like these even more because Knoxville has very few 3 bedrooms. Rents, we could raise them up there. There's not a lot of CapEx. We really love the median income of where that property is located. It's in a good area of Tennessee, of Knoxville. So when you guys are out there creating your buy right criteria, it's different because all markets are different. I live in Jacksonville. I'm 30 minutes south of Jacksonville. If I want a property built in the early mid 2000s in Jacksonville, it's very hard to find. The property is not available. There's not really any townhomes, let's say. So when you're going into a market, really start to understand that market, even from the LP, from the limited partner perspective, know what is in that market and start creating your criteria for that market. It's really important. We love townhomes because they're a nicer amenity. People love to live in them. It feels almost as if there's a home. Usually there's a porch out in the back. We hate decks. So if there's a property that has decks, we sort of tend to shy away from it. Doesn't mean that we won't buy them with decks. We just have to make that allowance in our budget to say in a few years, these decks are going to be taken care of. So go out there, figure out what the buy right criteria is, and then start focusing on that. And then let brokers know, let other property management companies, let other investors know that you're looking for that criteria. Because when it does pop up, you're going to say, wow, that deal fits my parameters. Hey, John, do you want that deal? Game on. Yeah, I love that deal.
Well, I think you brought something up that this is going to be Jake's nugget of wisdom that I'm going to throw in here is that you can buy lower cost properties. They seem attractive because the price is lower, right? You're like, oh, this is a unit and it's the same amount of doors as this one, but it's half the price. The lesson that I've learned is that when you're doing renovations, wire costs the same, toilets cost the same, sheetrock costs the same, HVACs cost the same. You don't get the decreased price across all of the things that you have to do to the property. Therefore, the cost of maintaining and upgrading the units as a percentage of the total is way up, right? And it really can impact your cash flows. So to your point, when you're buying newer properties, like you're not having to deal with nearly as much of that stuff. But when you buy that old stuff, like guaranteed, you're going to be replacing just about everything.
And that's why you got to be careful with the pricing. That it comes down to a price. And I think most investors, when they first start out, they don't understand price versus value. I mean, you're looking to be Mr. Cheapo. How many people out there are Mr. Cheapo? I've been Mr. Cheapo a lot of times. And sooner or later, Mr. Cheapo gets caught because you buy this asset, it looks great. And now that's one of the way debt's going to be pulling back on this part of the cycle. To finish answering your question, debt and the banks are going to come in and go, that's a 1960s asset. We're going to have to put a little bit more CapEx reserves aside because you've got cast iron plumbing there. You've got roofing in there. And by the way, 65 or maybe 70, but 65% LTV. So they're going to lend less. You're going to have to come up with a lot of money out of pocket. And a lot of these C assets, they're not going to get this pricing. They're going to have to start dropping this pricing. So I know that's occurring. I know that's going to continue to occur because banks don't want to get caught with those old assets because those old assets need tender loving care. And the problem is over the last 4 or 5 years, we know that we've been at a high because, assets are bought and then 18 months later or 2 years later, they're flipped. That's when you know you're coming towards the height of the market. And when you see all these 1031s occurring, those are two signs that we're heading towards the high or we are around the high. People have been saying this for the last 4 years. It's too high. I'm not getting in. I'm not getting in. And now we're going into recession and they're saying the same thing. Well, I can't buy because it's a recession. I think what you need to do is you need to learn all the different strategies, whether it's syndication, whether it's creative financing, whether it's doing JVs, partnerships, understanding your business plan. And I think any savvy real estate investor can buy when the market goes up and can buy when the market goes down. They just need to know when and what to buy in that part of the market cycle and how to deal with debt and reestablish what type of exit strategy they have. And when the market cycles are going down, your exit strategy may be a little bit longer. It may not be a 3 to 5 year hold. You may have to hold that property 7 to 10 years, but you'll know that as you're learning all of these different cycles. I think people have been waiting for pricing to adjust. And now that it's adjusting, people are all freaking out. So there's an opportunity for a lot of us out there to have these pricing adjust in this part of the cycle.
Well, Gino, this episode has been chock full of information, and I really probably could go on for another 30 minutes. But I got to be respectful of your time here. I always like to end my episodes with a bit of gratitude because somebody gave us a leg up. Somebody showed up out of nowhere that gave us a chance that we probably didn't deserve. And I want to give you an opportunity to give somebody a public shout out.
I think the first one is my wife. I mean, I wrote these down because I didn't want to forget anybody. I mean, she's been amazing. She's been instrumental. She's been by my side the whole time. She has been supportive. I've made dumb mistakes and she's always said, you know what, I've got your back, whatever you need to do. My partner, Jake Stenziano, amazing. I mean, without him, I don't think I'd be here where I am. We've really been the yin and yang to our partnerships. Craig Haskell, one of my mentors that passed away a few years ago, Value Hound Academy. He helped us on our third deal. Amazing mentor. I think he's one of the catalysts for me wanting to start the Jake and Gino community, wanting to give back. And those two other gentlemen you mentioned, Robert Kiyosaki, I think reading his books and listening to him and having him on our podcast. And then ultimately, I love Zig Ziglar. I mean, listening to him, I still listen to him when I go running. That Ziglar brand is just an amazing brand. He's got morals. He's a great salesperson. He's got an amazing message. And he's just an amazing motivational speaker. So I know you said one, but I mean, at my age, you can't just have one. There's so many people that have helped you along the journey.
Yeah, the more gratitude, the better. I think that's the point. So thank you so much for being on the show. I really enjoyed this conversation.
Thanks, Jake. Take care, everybody.
I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.